You click the button that says invest, and then you carry on with your life. You eat, you sleep, you go on holidays, all while your hard-earned money works for you, growing steadily. That is the promise of investing. But do you find yourself overwhelmed and confused with the complexities of investing, wishing for a simple and effective strategy to build your wealth from scratch? Don't worry, in this beginner-friendly video, we'll strip away the confusion and noise surrounding investing so that you can finally understand what the stock market is, how you can make money, and where to start investing. As the big man himself said, investing is simple. While there are many types of investing, from real estate, commodities, or even cryptocurrencies, for the purpose of this video, we will be focusing on stock market investing. To start with, I want you to imagine that you're at a bustling farmer's market, surrounded by vendors selling all sorts of goods: fruits, vegetables, freshly baked bread, and homemade treats. This farmer's market is just like the stock market, but instead of buying and selling fruits and veggies, people trade shares of publicly listed companies. So what is the stock market? Well, it's a place where people can buy and sell tiny pieces of ownership in big companies called stocks or shares. These stocks represent a small slice of the company's overall value, and when you own a stock, you become a part owner of that company. It's like having a little stake in the success, or sometimes the failure, of a business. Now, imagine each company as a different vendor at the farmer's market. Some vendors are well established and famous, like the big companies you might know as such as Apple, Microsoft, or Coca-Cola. Others are smaller and up-and-coming businesses, just like those mum-and-pop stores with unique and promising products. To understand how the stock market works, let's focus on one vendor. Let's call it the Life Simplified company. Let's say that you've heard great things about the amazing pies they make. You believe they're going to become very popular in the future and going to be in high demand, and as a result, the value of the company will increase over time. So you approach the stall of Life Simplified and offer to buy some of their shares. The vendor agrees and sells you a small portion of their company. Congratulations, you are now a proud shareholder of Life Simplified. Now, the stock market provides a platform for you to trade your shares with other people. It's like a lively marketplace with buyers and sellers coming together to exchange stocks. Just like at the farmer's market, the price of the goods can change depending on supply and demand. Let's say Life Simplified's pies become a sensation overnight, and everyone wants a piece of the action. Suddenly, more people are willing to buy shares in the company, driving up demand. When there is high demand, the price of the shares go up, and now your shares in the company are worth more than what you paid for them. On the other hand, if something goes wrong for the company, like a shortage of ingredients or a bad batch of pies, people might lose confidence in the company's future success. This could lead to more people selling their shares, creating more supply than demand. When there is higher supply and lower demand, the price of the shares go down. To keep everything fair and transparent, the stock market has a system in place. It matches buyers and sellers, just like how the farmer's market connects shoppers with vendors. It's a place where you can invest in the success of businesses you believe in, hoping their value will grow over time. Now, this is all well and good, but how do you get access to the stock market? Nowadays, it is as easy as ever to invest in the stock market. The easiest way is through an online broker or trading platform, and to open a brokerage account. This includes companies such as Vanguard, Charles Schwab, Hargreaves Lansdown, Trading 212, and Interactive Brokers, to name just a few. It is important you do your own research to find out which one is best for you, depending on the country you're based in and your key criteria. So you have decided to start your investing journey and ready to build that generational wealth. But how do you actually make money? There are two ways: through capital gains and dividends. Capital gains in the stock market refers to the profit you make when you sell a stock or other investment for a higher price than what you initially paid for it. It's the difference between the selling price and the purchase price. Let's say you bought 100 shares of a company stock at $10 per share, investing a total of $1,000. After holding the stock for some time, the price per share increases to $15. If you decide to sell all your shares at this price, you would receive $1,500. This means you made a $500 profit for your stock investment. It's important to note that capital gains are subject to taxation. The tax rate you'll pay on your capital gains depends on factors such as your income level and how long you held the investment before selling it. Dividends refers to a portion of a company's profits that are distributed to its shareholders. When you own shares of a company that pays dividends, you are entitled to receive a share of those earnings. Let's say you own 100 shares of a company's stock, and that company declares a dividend of 50 cents per share. In this case, you would receive a total of $50 as a dividend payment. Dividends are typically paid out on a regular basis, such as quarterly or annually. Companies that are well established and generate consistent profits often choose to distribute dividends to reward their shareholders. It's important to note that not all companies pay dividends. Some companies may reinvest their profits back into the business for growth and expansion instead of distributing them as dividends. Similar to capital gains, this is generally seen as taxable income. Now that we have covered the stock market, where to invest, and the ways you can make money, we can jump into the type of investment products you can invest in. The first way is by investing in individual company stocks. For example, deciding to directly invest in shares of Apple, Microsoft, or McDonald's. So let's go back to our fictional Life Simplified company example. If you buy one stock in the company, as shareholder, you may have the right to vote on certain company matters and potentially receive a portion of the company's profits in the form of dividends. Now, there are plenty of advantages of vesting in this way. Firstly, it gives you full customization. It is extremely personalized, where you are hand-picking the companies you are investing in. Secondly, you are in full control of your investment strategy. It also provides the potential for high returns if the company does well. And finally, due to the above, it is probably the most fun way to invest. On the other hand, there is high level of risk and volatility. Investing in individual stocks carries a higher level of risk compared to other investment options, where the value of the company stock can fluctuate widely. Lack of a diversification. Investing in individual stocks exposes you to company-specific risks. If your company you invested in performs poorly or faces financial difficulties, it can have a substantial negative impact on your investment. Diversification across multiple stocks is important to mitigate that risk. Lastly, time and effort. Investing in individual stocks requires research, analysis, and monitoring of the companies. It demands time, knowledge, and continuous attention to make informed investment decisions. Not everyone may have that desire or expertise to dedicate to this level of involvement. Before we get on to what I believe is the easiest investment strategy, I want to discuss the option of mutual funds, specifically managed funds. This is where your money is pooled together along with other investors into a pot, called a fund, that invests in a wide variety of stocks, bonds, or a mixture of both. This is then managed by a professional fund manager. Each fund has an overarching strategy of what they invest in, so you can make a decision before investing your money in a fund. Once you have made your decision and choice, you effectively become a shareholder of the fund. The value of your investment is determined by the performance of the investments held in the fund. If the investments within the fund increase in value, the price of each mutual fund share goes up. So let's outline the advantages and disadvantages of investing in mutual funds. The positives focus on, firstly, diversification, as funds will invest and have exposure to a wide range of companies, so you're not just tied to the performance of one company in case it does badly. Secondly, professional management. Mutual funds are managed by experienced investment professionals who conduct research, analyze market trends, and make investment decisions on behalf of the fund. Finally, convenience and time saving. By investing in mutual funds, investors delegate the responsibility of researching, selecting, and managing individual securities to professional fund managers. This frees up your own free time. As for the disadvantages, the main downside is the fees and expenses. Mutual funds typically charge management fees that are deducted from the fund's assets and can impact investment returns. Secondly, the lack of control. When investing in mutual funds, investors give up control over individual investment decisions. The fund manager makes choices on behalf of all the investors or shareholders in the fund. So after covering individual stocks and mutual funds, I want to cover my personal favorite way to invest, and that is through index funds. Now, index funds are a subcategory of mutual funds, which include other things such as growth funds and income funds, among others. To explain index funds properly, we have to go back to the stock market definition we discussed earlier in this video. A market index, in the simplest terms, is a group of companies on the stock market that are used as a benchmark. A well-known one is the S&P 500, which tracks the performance of 500 large companies listed on the US stock exchange, which include companies like Apple, Amazon, Microsoft, and so on. Now, instead of trying to buy shares of each of these 500 companies, which could be quite expensive and time-consuming, you invest in an S&P 500 index fund, such as the Fidelity or Vanguard 500 index funds. These funds are designed to own shares of all companies in the S&P 500 in the same proportions as they exist in the index. By investing in an index fund, you effectively own a tiny portion of each of these 500 companies. So, if Apple represents 3% of the index, your investment in the index fund will have a 3% exposure to Apple. The value of your investment in the index fund will go up or down based on how well the overall S&P 500 index performs. The goal of the index fund is not to outperform the market, but to match its performance. As we move on to the advantages of index funds, you'll understand why this matters. Most investors, including a lot of professionals, struggle to consistently outperform the market over the long term. Therefore, matching the market and benefiting from the overall growth of the market in the long term is a major benefit. Secondly, it's simple and massively time-consuming. You don't need to constantly buy and sell individual stocks. And finally, index funds are often considered a more cost-effective and less risky way to invest compared to actively managed funds. As far as the disadvantages are concerned, there is limited potential for outperformance. Index funds are designed to match the performance of the underlying index rather than outperform it. And also there's the lack of flexibility, as you are tied to the index rather than being able to customize with individual purchases. So after discussing some of the investment vehicles, I want to cover who investing is for. While investing can result in significant returns on your money, it is important to note that it can also be volatile and subject to market fluctuations. Therefore, investing should really be for medium and long-term goals, and deciding what method and investment strategy should be influenced by those goals and your personal risk tolerance.